Welcome to this CPA SkillNet webinar. Our topic today is performance evaluation in divisionalised organisations, a topic in Professional 2, Strategic Performance Management. We're talking about profit centres and investment centres. These are autonomous business units in large organisations. Controlling these units poses two problems for top management. First of all, to design a performance evaluation system for the business units so as to achieve goal congruence. In other words, motivate the business unit managers to maximise shareholder value. And secondly, to motivate the managers to use assets efficiently and to make good investment decisions in relation to buying new assets. First of all, profit centres. A profit centre typically looks like this. The manager has the authority to make operating decisions, things like what products to sell, what raw materials and other inputs to buy, what customers to target, etc. But the manager doesn't have the authority to decide on investment. He or she can't decide how much capital, for example, should be invested in the division, or what fixed assets to buy. These operating decisions impact on the revenues and operating costs of the division, in other words, on its profit. Consequently, the business unit is treated as a profit centre and the manager is evaluated on a profit performance basis, comparing actual and budget profit. There are a number of possible measures of profit which could be used, and this is a layered income statement which shows the different measures of profit. So like any income statement, it begins with sales, both to external customers and to other divisions of the same organisation. Then deducted are variable costs and controllable fixed costs, which are incurred as a consequence of decisions by the division manager. For example, decisions as to what raw materials to buy and perhaps what assets to lease. This gives the first profit figure called controllable contribution. Then we deduct non-controllable avoidable costs. These costs can't be avoided by the decision manager's own decision, but they could be avoided if the division were to be closed down. This gives us the contribution of the division to the organisation, which is our second measure of profit. And then finally, a deduction is made for an allocation to the division of part of the headquarters expenses. That gives divisional net profit before tax. So three different profit measures. The first of these, the controllable contribution, is the most appropriate profit measure to use in assessing the performance of the division manager as an organisation. As an individual, I should say. In other words, his or her controllable performance. But then if we want to measure economic performance, that is, assess the contribution of the division to the organisation as a whole, we would use one of the other two measures of profit. Divisional contribution would indicate the incremental contribution of the division to the organisation. Or in other words, the contribution which would be lost if the business unit were to be shut down. Net profit before tax is a longer-term measure. It measures the long-term contribution of the division to corporate profit. Because, for example, if the division were to be discontinued, then perhaps the headquarters could become slightly smaller and its cost would eventually decrease. Secondly, we turn to investment centres, and these are really a special type of profit centre. In an investment centre, the manager has the authority to make both operating decisions and investment decisions as well. Therefore, when it comes to evaluating performance, measuring the profit earned wouldn't of itself be sufficient, because it doesn't capture the consequences of investment decisions. There are three possible measures of financial performance. We'll look at these in more detail in a moment, but we'll just name check them first. These are return on investment, or ROI. Secondly, residual income. And thirdly, economic value added. But how does the investment centre manager really influence the amount of capital invested in the division? Well, in a number of ways. First of all, the manager may have the authority to decide on certain purchases of fixed assets, subject to a maximum amount. But secondly, through ordinary operating decisions, it's likely that managers' actions will affect the level of investment in inventory and debtors, and these can be significant assets of the division. Consequently, we'd say that most profit centre managers in practice do influence the level of investment directly or indirectly, and therefore in most cases it's appropriate to treat them as investment centres rather than basic profit centres. So we have these three possible performance measures for investment centres: ROI, residual income, and EVA. Return on investment is a percentage. It measures profits as a percentage of the capital invested in the division. So it's simply a profit in the accounting sense divided by the total capital investment. The capital investment includes both fixed assets and also the net working capital of the division. Residual income is not a percentage, it's an amount of money, an absolute measure, and it consists of accounting profit minus a finance charge for the cost of the capital investment. So once again, the accounting profit is used as the starting point, and then the finance charge is deducted. And the finance charge is the division's cost of capital multiplied by the book value of the investment in the division. EVA is a registered trademark, and it could be described as a variant of residual income. It's similar to residual income in being an absolute measure, but it's based on a number of adjustments to the basic accounting numbers rather than taking them at face value. The objective is to overcome the conservative bias which may underlie accounting figures and give us numbers which are closer to economic reality. So the EVA is calculated by first of all taking the net operating profit after tax, then making a number of accounting adjustments, and then making a finance charge. The finance charge is again the cost of capital multiplied by investment, but again the investment is not taken necessarily at simply face value from the balance sheet, rather it's adjusted if necessary to reflect the economic value of the assets of the division. So what's the relationship between these performance measures and goal congruence? Well, in an ideal world, maximization of shareholder value would be achieved if managers allowed their decision making to be guided by net present value or perhaps internal rate of return. However, we can't simply say that ROI is the same as IRR, even though both are percentages, nor can we say that residual income is necessarily the same as net present value, even though both of those are absolute measures, numbers of euro. Net present value and IRR, they are both future-oriented discounted cash flow measures, so they measure the future, not the past, and they attempt to capture economic values and long-term wealth effects. By contrast, as we've seen, ROI and RI are both based on historical accounting measures and therefore don't necessarily capture economic values or true wealth effects. How then do the performance measures affect managers' motivation? Well, managers have an incentive to concentrate on aspects of the performance which will be measured, and therefore certain aspects of performance, if they won't be measured or captured by the performance measure, may be neglected, even if it's likely that these will impact on the amount of shareholder value created. Consequently, investment centre managers are likely to act in such a way so as to maximise the measure of performance in accordance with how they are measured. So therefore, if the manager is evaluated on the basis of ROI or residual income, then the manager may use that particular performance measure as the key decision criterion and evaluate any proposed capital investment on the basis of the measure which is used. Criteria which would maximise shareholder value are net present value or internal rate of return, but the manager may not focus on those so much as on the accounting performance criteria of ROI and residual income. Consequently, some of the decisions which result may be dysfunctional in the sense that they don't result in necessarily the best outcome from the shareholder point of view. Also, the accounting performance measures may not be particularly informative as to how good or how bad a job the manager has done on behalf of the shareholders. And let's develop a couple of examples of that. This first illustration of a possible dysfunctional effect is in a case where the manager has made a good decision, but this isn't captured by the performance measure used. In this first example, the manager makes a beneficial investment in an intangible asset, for example something like research expenditure, which is to the long-term benefit of the organisation and its shareholders, and in that sense has a positive net present value. But the problem is that this good decision may have the effect in the short term of adversely affecting the financial performance which is reported by measures like profit or return on investment. The reason is that the costs incurred are expensed immediately to the income statement in the current period, therefore pushing down current period profit, and the intangible asset isn't shown as an asset in the balance sheet because of the conservative orientation in financial accounting rules. Therefore, someone looking at the financial performance measure may draw the inference that the manager has made a bad decision in some way, and as a consequence the manager may be penalised and disincentivised, in spite of the fact that the decision which has been made is actually a good one from a shareholder point of view. A second illustration of the dysfunctional effect is of the situation where the manager makes a bad decision, but the performance measure in this case signals otherwise. In the second example, the manager postpones essential machine maintenance expenditure. Now, this action is wealth destroying, because although it saves some money in the short term, the long-term consequences is that the machines become less efficient, less productive, and they shorten their economic life. But in the short run, the effect on the profit or return on investment or other accounting performance measure is likely to be that they are affected in a favourable way because of the short-term cost saving. The problem is that the long-run adverse consequences aren't captured in the short-run financial performance measure. So again, somebody looking at the financial performance measure might draw an incorrect inference. The inference appears to be that the manager has made a good decision because financial performance has increased in the short term, but the inference is incorrect in the sense that shareholder value has been diminished. Any short-term benefit is more than exceeded by long-term damage to shareholders' interests. Let's now take a closer look at return on investment. In this example, a fairly simple capital investment is being considered by a division manager, and the division already exists, has some other capital investments. The table in blue shows a number of things. At time zero, if the asset is acquired, it involves a cash outflow of €2,487. And this is followed in the following 3 time periods by cash inflows of €1,000. Now in the second table, we try to assess this from the shareholder's point of view. So the second table in pink shows that this appears to be in shareholders' best interests. It's been assumed here for illustrative purposes that the cost of capital is 8%, and on that basis the project has a positive net present value. The internal rate of return of the project comes out at 10%, and that is more than the 8% cost of capital. So therefore, on a discounted cash flow basis, it's clear that this project is in the best interest of shareholders, and the shareholders would favour acceptance of this. Let's see what the impact would be on return on investment if the division manager were to accept this. Well, first of all, the accounting profit impact. In all 3 years, the accounting profit impact would be positive €171. That's because in each of the 3 years the cash flow is €1,000, and for purposes of this illustration I've assumed a straight line depreciation, which gives €829 per year. So every year the profit impact is positive. Now return on investment can be worked out on either of 2 bases, so shown both of them here. The first one, using the table in blue, is the case where return on investment is found by taking the profit and dividing it by the net book value of the investment at the beginning of each of the financial years. So at the beginning of the first year, for example, the asset has just been acquired, it hasn't been depreciated yet, and therefore its book value is 2,487, the cost of acquisition. So if we divide the profit by the net book value, then in the first year the return on investment is 6.8%. Coming to the second time period, well, at the beginning of the second time period, the net book value of the investment has been reduced because 1 year's depreciation has been charged. So the depreciation, as we saw, is €829 per annum. So by the beginning of the second year, the book value of the asset is 1,658. So the return on investment in year 2 is the same profit, €171, divided by a smaller net book value of the investment, giving a bigger return on investment of 10.3%. And in the third year, another year's depreciation has been charged, so the net book value of the investment has shrunk again. So the net book value is now 829. So the profit of 171 divided by 829 gives a profit of 20.6%. So we see in that case the return on investment increasing over time because of the fact that the net book value of the asset has diminished as depreciation has had an effect. The second possible way to work out return on investment is shown by the table in green. In this case, return on investment is calculated by taking the profit and dividing it by the gross book value of the investment. So in other words, every year we simply divide the profit by the cost of buying the asset in the first place. And therefore the return on investment is 6.8% in each of the 3 years. Well, those are the ROI numbers. So how would it be likely to impact on the manager's decision as to whether or not to go ahead with the investment? Well, first of all, let's consider this example. The manager has set himself or herself a budget target of 8%, which is the cost of capital, and also the manager is primarily interested in the short-term impact in the first year. Well, if that's the case, the manager is likely to reject this project because the return on investment in the first year is less than the target 8%. As we saw, it's 6.8%. It's true, of course, that return on investment is much higher in the second year and even more so in the third year, but that may not impact on the manager's decision significantly if he or she is primarily concerned with the first year impact. So in that case, the manager's decision to reject the investment is not consistent with shareholders' interests, because as we saw, the shareholders would favour the investment going ahead. Another consideration is that the decision in any individual case may be affected by the ROI being earned by the division on its existing capital investments. So in this example I've said, supposing that the business unit is at present doing quite well, and from its existing capital investments it's earning a return of 25% on average. Well, if that's the case, then only projects with a return on investment offering more than 25% will be attractive, because anything with a return of more than 25% will increase this average. So this particular proposed investment has quite a good return in the third year and the second year, but nevertheless in no case is the return more than 25%. And as a consequence, this project is likely to be rejected by the manager because it would bring down the average from its current very high 25% level. So this reinforces the manager's likelihood of rejecting the project, even though acceptance of it would be the best thing to do from a shareholder interest point of view. The problems in this case arose partly because of the effect of using net book value as the measure of the investment base. As we saw, the depreciation has the effect of reducing the size of the investment base, and therefore the ROI is very small in the first year and does increase automatically in the later years. Now, one consequence of that is that in year 2 and year 3 a manager would not be likely to want to replace the asset with a brand new one. The problem is that any brand new assets are shown in the accounts at a very high value because no depreciation has been brought into effect yet. So it's quite likely that managers will wish to retain a highly depreciated assets, even if it would be optimal from a shareholder point of view for them to be replaced. The alternative, as we saw, is to work out ROI on the basis of taking the profit and dividing by the gross book value of the investment. This has the effect of giving a consistent ROI over the years of the project life. The ROI does not increase over time in the way that it does if net book value is used. But this approach also has its problems. In particular, it has the problem that no allowance is made for the age of the asset, even though realistically an asset which is a couple of years old might be expected to be less productive and less profitable. And therefore, from the perspective of the manager has an incentive to dispose of an asset, even if it's economically reasonably viable, at quite an early stage in its life. Because once its productivity diminishes even a little bit, there's nothing to be gained by retaining it, given that its book value is still retained at its original or purchase price in the ROI calculation. So let's now summarize the relationship between ROI and goal congruence. Is ROI a goal congruent performance measure? Well, the answer, as we've seen from this example, is that ROI isn't necessarily a good indicator of whether a proposed investment is desirable in terms of generating shareholder value. It may lead to a decision which is contrary to shareholders' best interests. So in that sense, we would say that ROI is not necessarily a goal congruent performance measure. But we must then ask the question, why is it that ROI is very popular in practice? It's probably the most popular measure of divisional performance. So in spite of all of these apparent weaknesses, it's a very commonly practiced technique. Well, we can identify a number of possible reasons. First of all, it's an easy number to compare with other divisions. ROI is a percentage rather than an absolute number. This makes it easy to compare with other divisions or even other companies, even if they are very different in size. Secondly, and again this is a feature of it being a percentage, it's possible to compare ROI with a firm's cost of capital to give at least a rough indication of the economic viability of the division or the proposed capital investment. Now we might reasonably say that this is not a true like-with-like comparison, because ROI, as we saw, is based on accounting numbers rather than economic substance, but nevertheless it's a useful approximate comparison. Thirdly, perhaps some of the limitations of ROI can be fixed and aren't as severe in practice as the example we've just seen might suggest. We saw in particular that ROI was very low in the first year and rose rapidly thereafter. And because of the manager's time horizon and the focus on the short term, we said that was likely to lead to the investment being rejected. But that particular result was affected to a significant degree by the depreciation method used and the use of straight line depreciation. One way to solve the problem somewhat is to use a different depreciation method, and in particular one which will backload most of the depreciation into a later year. If that is done, it will have the effect of giving a more even return on investment pattern, so that the earlier years look better and all of the benefit isn't backloaded into a later year. And therefore the benefit of the investment becomes more obvious to the manager in the short run, and the investment becomes attractive. Another reason why ROI is a popular performance measure is because it is widely understood and widely used externally to evaluate the performance of companies. It's very likely that investment analysts or other professional outsiders will use ROI as a key measure in assessing and commenting on the performance of the company as a whole. Therefore, in terms of the top management of the company, they're likely to see ROI as a key overall performance focus or measure for the entire organisation, and may therefore set ROI targets for individual divisions so that the overall target ROI for the organisation as a whole is achieved. Also, ROI can be broken down into detailed elements to see the causes as to why ROI of a division is not, for example, achieving its target, if that's the case. So this is the so-called DuPont system of ratio analysis. It's shown by a diagram coming up on the next slide. We see here ROI being broken down into causal elements. At the most aggregate level, ROI is driven by profit as percentage of sales and asset turnover. Asset turnover is in turn determined by the level of sales, the level of assets. We can distinguish between fixed assets and other assets and so on. So in various ways, the overall ROI performance can be broken down into its detailed causes. So if the ROI has not been up to target, for example, it's possible to identify by means of that analysis areas where corrective action is required in order to achieve the level of performance improvement that is needed. Now let's turn to residual income and take a look at that. As we saw before, residual income is calculated in this way. It's accounting profit minus a finance charge, the finance charge being the division's cost of capital multiplied by the total capital invested in the division. So let's take the same example as before and work out the residual income effect. So again in pink we see the cash flows associated with the investment, cash outflow times 0 when the asset is bought for 2487, and then each of the following 3 years a cash inflow of €1,000 per annum. In the middle table then, we assess the project from the shareholder point of view. At the assumed 8% cost of capital, it has a positive net present value of €90, or the IRR, as we saw before, is 10% and therefore higher than the cost of capital. So the project adds value, it's attractive from a shareholder point of view, and the shareholders would like to see this being accepted. But let's see what the residual income effect will be to see whether their manager is likely to say yes or no to this. Well, the accounting profit is, as before, it's just the operating cash flow minus the depreciation. So if depreciation is worked out on a straight line basis, this gives a profit every year of €171. Well, residual income can be worked out on two bases, just like ROI. In the first case, the finance charge is based on the gross book value of the investment, in other words, what was paid for the asset when it was acquired. So this is shown by the table in blue here at the top. The gross book value of the investment, it was bought for 2487. The finance charge is the cost of capital, which we said was 8%. So that's applied to the gross book value of the investment, giving a finance charge of €199 per annum. So we can see from the bottom table in green there what the residual income is. It's the accounting profit every year of €171 minus the finance charge of €199, so €28 of a negative residual income figure every year. So accepting this investment would decrease residual income by €28 per annum, at least if this particular approach to measuring residual income is adopted. The alternative is to measure residual income differently, basing the finance charge on the net book value of the investment. So again, this is about allowing for the asset to diminish in value because of the depreciation charge. So the table at the top in purple shows the finance charge. In the first year, the net book value at the start of the first year was 2487. If the finance charge is applied to that, 8% cost of capital gives a finance charge of 199. But then in year 2, as we saw before, after deducting the first year's depreciation, the asset has a book value of 1658. The cost of capital, 8% of that, is the finance charge of 133. So the finance charge gets smaller as a consequence of the book value of the asset diminishing in value. So by the third year, another year's depreciation has been charged, and the finance charge is only €66. The table in pink shows the residual income effect for each of the 3 years. The residual income increases over time in this case because the accounting profit is the same, €171 per annum, but the finance charge gets smaller because we have applied the cost of capital to the net book value of the investment. So the residual income is negative €28 in the first year, but rising to positive €38 in year 2 and a positive €105 in year 3. Well, how will the manager react if that residual income performance measure is used? Let's consider a number of possibilities. In the first case, suppose that residual income is measured on the basis of gross book value. In that case, it seems certain that the manager will reject the project, because as we saw, on that basis, residual income is going to be negative in all 3 years. Case 2, assume in this case that the manager is assessed on residual income, but this time using net book value as the basis of determining the finance charge. In that case, it's not possible to say with certainty what will happen, but we can say that the manager is likely to turn down the project, especially if he or she has a short-term time horizon, because of the fact that in the first year the residual income is negative. So if the first year is the manager's main concern, then the project looks very unattractive. So in another case, has goal congruence been achieved? As we saw, the project has a net present value which is positive, and therefore acceptance of the project is what the shareholders desire. Acceptance would create shareholder value. And therefore, in this particular example at least, the residual income measure has failed to deliver a goal congruent decision. However, it's fair to say that in at least one way, residual income is less dysfunctional than return on investment. To consider this, let's take this fresh example as shown by the table in blue here. So we have a division here whose existing investments are giving it an average ROI of 20%. The division's cost of capital in this example is assumed to be 10%, and a new project is being considered which has a return on investment of 12%. Looking at these numbers, it's fair to say that the proposed new project is likely to have a positive net present value. It's likely to be in the shareholders' best interests, because of the fact that the ROI of 12% is more than the cost of capital of 10%. We can't say with certain, we would need to do a proper discounted cash flow analysis, but based on the data that we have, it is likely to be in shareholders' best interest that this be accepted. How will the manager react to this investment? Well, first of all, if the manager is evaluated on the basis of ROI, the project would reduce the division's average ROI, because the project offers a return of 12%, which is less than the division's existing average return of 20%. So the manager is likely to say no to this proposed project. This appears not to be goal congruent, because the return on the investment of 12% is more than the division's cost of capital. So it's likely that shareholders would favour acceptance. That problem doesn't arise if the manager is evaluated on the basis of residual income. The project is likely to have a positive residual income effect, because the accounting profit shows a 12% return, and the finance charge, of course, is always based on the cost of capital, which in this case is only 10%. So it's likely that the residual income effect would be positive. So the manager would be likely to accept the project, and that decision would, of course, be in the best interest of shareholders. There is a similarity between net present value and residual income, but is a similarity and not more than that. Can we say, for example, that the project net present value is the same as the present value of the residual income? The answer is a heavily qualified yes. They are the same, but only over the life of the entire project. So let's take the main example we had in this illustration. As we saw, the project net present value was €90, and on a net book value basis, the residual income figures were shown in the table in pink here. If we discount that stream of residual income numbers at the firm's cost of capital, which is 8%, it comes out at €90. So the project net present value is the same as the residual income and net book value over the life of the project. The implications are that in the long term, that is over the life of the entire project, residual income maximisation is consistent with maximising a net present value. So in that sense, the manager and the shareholders have the same interests. But the problem is, and we saw it in this example, even though the project has a positive net present value, nevertheless residual income may be negative in some years. And therefore the manager may reject the project, especially if the residual income is negative in the first year and the manager has a primarily short-term orientation in decision making. So let's summarise the limitations of residual income as a performance evaluation measure. First of all, it's an absolute measure. That's to say it's a number of euro, not a percentage. And that makes it difficult to compare the performance of two divisions which are of different sizes. If there are different amounts of capital invested in them, then we would expect them to earn different amounts of return in money terms, and therefore it's difficult to compare the residual income of a large division with that of a small division. Secondly, residual income is rather unfamiliar to outsiders. They are more likely to use ROI as the basic overall financial performance metric. So residual income is a less familiar performance measure, and that may pose some difficulties in assessment. And finally, as we saw, residual income is not guaranteed to be goal congruent because the residual income in a particular year may have a different sign from the project net present value.